In the late 1800s, a man named Charles Dow revolutionized the financial world. We're going to talk about how. If you haven't heard of Charles Dow, you more than likely have heard of his legacy. He started Dow Jones and Company, he started the Wall Street Journal, and he laid the foundation for modern technical analysis through a series of principles known today as Dow Theory. Well, there are 6 basic components to Dow Theory. They include that there are 3 main market movements, there are 3 trend phases within the market movements, markets are efficient, indices must agree, trend must be confirmed by volume, and something that for right now I'm going to call Newton's first law. Well, the 3 market movements are main, medium or swing, and short movements. The main movement or overall trend can last for years. Within that main movement is the medium or swing movement. The swing movements can go with or against the longer term move, but tend to last for shorter periods, weeks to months rather than years. The short movements last hours to weeks, and according to Dow Theory, short movements are mostly noise and can be emotionally driven. The 3 trend phases are accumulation, absorption, and distribution. The accumulation phase, according to Charles Dow, is when institutions and other well-informed investors are buying. There's not often much movement during the accumulation phase, as these investors are very steady and they're often secretive in their approach. Now, the second phase is absorption. This is when other investors begin buying. Often driven by technical analysis, these traders tend to be trend followers. The third phase is distribution. And that's when informed investors begin selling their shares to the rest of the market. A Dow Theory relies on an efficient market. What that means is because the market is made up of every investor out there, all known information is factored into the value of the market. Well, this includes company-specific information, sector-specific information, market-specific, macroeconomic, and microeconomic information. According to Dow Theory, you cannot outsmart the market. The only way to outperform the market, according to Charles Dow, is to trade with the market rather than try to beat it. Now, Charles Dow originally came up with 2 indexes to measure stock market performance: the Dow Jones Transportation Index and the Dow Jones Industrial Average. The Dow Jones Transportation Index originally tracked 11 transportation companies, most of them railroads. Today, the index tracks 20 transportation-related stocks. The Dow Jones Industrial Index originally tracked 12 industrial stocks, and today it tracks 30 stocks. The idea that the 2 indexes must track each other is one of the central tenets of Dow Theory. For example, if industrials are going up without transports, it means there's a disconnect in the market. Until that disconnect is resolved, the market outlook is uncertain. The next component of Dow Theory is what I referred to earlier as Newton's first law. Newton's first law can be paraphrased as an object in motion will stay in motion unless acted on by a force. In trading, that means that a trend will continue until something changes. In other words, until there is definitive proof that the trend is over, the trend is likely to continue. Now, the final piece of Dow Theory is that trends should be confirmed by volume. Charles Dow believed that for a trend to continue, volume should rise to support the trend. Well, this one in modern markets is only partly true. Volume is still a necessary driver for downward trends, but it's not so with the uptrends. With the growth of retirement accounts such as 401ks, mutual funds, pension funds, sovereign wealth funds, and other institutional investors, the market no longer needs volume to move upward. There will always be a buyer. All you need for the market to go up is a lack of sellers. As you can see in this chart, increasing volume does appear to be necessary for downward movement. But when volume decreases, markets tend to move up. The basic tenets of Dow theory laid the groundwork for modern technical analysis. The concepts of trend, support and resistance, volume analysis, and comparative charting, all of these were advanced by Charles Dow.